If you think the market is improving right now, you might be reading it completely wrong. Rates are up. Freight is moving. But at the same time, hiring is getting harder. Costs are rising, and drivers are harder to find. So what actually changed in the last 30 days, and what does it mean for you? And stick around, because I'll show you what's actually causing drivers to leave right now, and what's killing your chances when you finally get them on the phone. Dry van truckload rates climbed throughout March, getting close to levels we haven't seen since 2021 and 2022. It sounds like good news, but there's a catch. There are fewer drivers looking for jobs right now. Google search activity for truck driving jobs is still down more than 19% year over year. Fleets are making more per load, but they're also paying more to find fewer drivers. And when you look at recruiting costs, well, that pressure gets even clearer. Overall lead costs dipped slightly, but that's not the full story. Company driver lead costs are up 28% year over year. Owner-operator leads jumped 8% in March, the highest levels since 2022. And hiring costs for company drivers spiked 20% in a single month. So yes, revenue may be improving, but it's getting more expensive and more difficult to hire. Now, it would be easy to look at the rising rates and just think that the market is indeed recovering, but that's not what's driving this. This is happening because capacity is shrinking. Dry van employment is now back to levels we haven't seen since 2013. Rates are going up, but it's not because things are balanced. It's because there are fewer drivers in the market. And fleets, well, they're already reacting. Pay is increasing as freight becomes more profitable, getting close to peak 2018 levels. And in March alone, over 38,000 new truck orders were placed. That tells us something important. Fleets are preparing to add capacity, but those trucks aren't on the road yet. So demand is rising right now, but the supply hasn't caught up. And then there's fuel. This might be the biggest wild card right now. Diesel jumped from $3.89 to $5.40 per gallon. And that's not just a cost increase. That's margin pressure overnight. If your fuel surcharge isn't keeping up, you're losing profitability, even with the higher rates. And on the freight side, volume is clearly up. Total load postings are up 21% year over year. Spot rates are up 24%. Dry van is leading with loads up 27% and rates at a 4-year high. Refrigerated is more stable, but still climbing. And flatbed is seeing steady growth across both volume and pricing. Across the board, freight is moving. The problem isn't demand, it's supply. And here's where this really starts to impact hiring and you. Drivers aren't just randomly leaving jobs, they're reacting to specific triggers. 47% say they start looking when their paycheck drops and stays down. Not when it dips, but when it stays down. 24% say it's how they're treated. 21% say it's policy changes that hurt the drivers. And only 6% say it's about home time. So it isn't just about pay, it's about consistency and trust. And when they do take a call, here's what immediately kills your chances. 38% say they hang up if the recruiter sounds like they're just reading from a script. 30% if they won't give a straight answer on pay. 15% same thing with home time. And another 15% if they feel like they're being talked over. Think about that. You're paying more to get fewer leads, and then losing them at the first point of conversion. Now, this is where the bigger picture really matters, because when you zoom out to the broader economy, you start to see why all of this is happening.
In general, it's going to be a fairly positive report. If we take a look, March dry van truckload rates continued to climb up. Data from DAT here showing that those rates are, on absolute terms, basically back to almost mid-2021 levels or mid-2022 levels, if you want to look at it that way. That's, again, all-in basis. On a line haul basis, looking through March, we did see a bit of a dip down. That was due to that big surge in diesel prices that we saw in March from February, where we ended the month of February around like $3.89 a gallon nationally, and then we're somewhere into the tune of about $5.40-ish a gallon. So on a pure profitability basis, things have come down. So we're not as profitable as what we were in the back half of 20 or any time in 21, but we're comparable in absolute terms to the peak of 2018 level of profitability. So it's been a nice improvement for carriers, especially those that are a little bit more on the fuel efficient side. In terms of what's driving this, it's important that we don't get ahead of ourselves in terms of the demand side. And I'm hearing phrases like manufacturing renaissance and things like that. And really what's important to note is if we look at, let's say, Institute for Supply Management's index of new orders, while we are in expansion territory, and we have been for January, February, and March of this year, this is a relatively sort of muted expansion territory, 2012-ish, 2016-ish, early 2019-ish. Certainly nothing like 2014 or 2017 and 2018. And if we look at separate, similar type of survey data in terms of aggregate business conditions from 5 regional Fed Bank manufacturing surveys, we're kind of in the bearish period. And so really this isn't about robust demand across the board. Now, certain sectors, anything affiliated with data center construction is doing phenomenally well right now. But anything dealing with, let's say, single family housing, that's struggling a lot more. So the big story though is the supply side. And if we take a look, we've seen this big drop in capacity that was continuing all through 2025, may have accelerated a little bit in the last quarter of the year with additional enforcement. We've seen capacity fall down based on BLS survey data to, I'd call it 2013 type of levels in the dry van sector. And so we've now lost the same amount of employment in this industry, in that dry van over the road space, is what we saw coming out during the 2001 recession, but there the whole economy fell into a recession. Now, the question about capacity being added back, we do see some evidence that new Class 8 truck orders have been quite robust based on FTR's data. So March, as an example, was 38,200, which is up very substantially from where it was last year at this time. We've seen several really strong months since December. That does suggest the carriers are looking at adding capacity, but that's not going to be for many more months. And what we do see is that connection between essentially spot truckload rates on a line haul basis and then Class 8 new orders, that relationship has completely reasserted itself. So we're back to sort of the old dynamics. And so what that would suggest is as long as line haul spot rates stay really strong, we should expect orders to be robust in April. Again, what we're trying to really get a sense on is the magnitude of sort of the price shock that we are going to be experiencing this year that we were not planning on with the Iran war. We just can't fully say what that is going to be yet. And so we're waiting for clarity on that. But that concludes our April update, and we'll be back with you in May, where hopefully it finally is not snowing here in Michigan.
So combining that with what we're seeing in recruiting, freight, and driver behavior, it starts to paint a pretty clear picture. This isn't a clean recovery. It's a tightening market with rising pressure in the areas that matter most. Hiring is getting harder, costs are rising, and the margin for error is shrinking. The fleets that recognize that now and adjust, well, they're the ones that are going to win over the next few months. If you want a full breakdown, all the data, charts, and insights from this month, you can get the full 30-day reset download for this month below. It's free, and it gives you a much deeper look at everything we covered today, including the slides featured in Jason's economic update. We'll be back next month with another 30-day reset with all the latest data. Until then, thanks for watching.